So are we set up for disappointment in the oil market, and why?
I think we are. I think the market has overdone it. There's a lot of geopolitical risk, so finally the geopolitical risk is in the price. And the technicals were responsible for a lot of the momentum. But I think the market is really believing, by and large, that when OPEC meets on November 30th, they're going to extend their production cuts until the end of 2018. And I think that's just not likely to be the case. So whether they don't extend and have a postponed meeting to January or February and reassess the situation, or whether they just do another quarter of an agreement on the cuts through the first half of the year, I think the market will be pretty disappointed, and I think they're up for a sell-off, as they have been at almost every OPEC meeting in recent years.
You have a deep understanding of what's happening in Saudi right now. The rhetoric versus the agreement. So if the rhetoric heats up between Saudi and Iran, what does that wind up meaning for an OPEC agreement?
Actually, nothing. The Iranians are in a position where they want to keep the cuts in place. The Saudis want to keep the cuts in place. The Saudis are not in the same position they've been in the past when they've used their oil weapon, namely their spare capacity to bring prices down, to use that as an instrument of foreign policy. They too want the prices up. So I think the market will be a little bit more fragile because of this heightening of geopolitical tension. But I don't think it really has anything to do with the oil price when push comes to shove.
So then what's your base case for November 30th? That they postpone a decision, that they wind up extending it but shorter than the market thinks?
Yeah, that's the base case. That's exactly right. We think the most likely scenario is that they're going to be pushing back the decision until sometime in the middle of Q1. We think that there might be some pressure on the Russian side to get the extension into the second quarter of the year, because Putin's election is at the end of Q1, and he'd really like to have stability in the oil market. But Q1 won't do it for this market. The market really thinks that the rebound, particularly now of higher prices, of shale production is going to be stronger the longer we have a higher price scenario in the short run.
So what's the downside for oil?
The downside for oil is a lot more production in the U.S. I mean, you get to a $65 price, and that's a lot of new hedging. And already, a typical U.S. independent can hedge out the market for the full year 2019. The calendar year strip is above $52. That's kind of a magic number for hedging. So the more they grab onto that certainty in terms of revenue, the more likely we're going to see more production growth.